Welcome back. Now, despite strong growth witnessed by general insurance industry, New India Assurance is one company which has largely missed that growth train. Speaking exclusively to CNBC-TV18, Girija Subramanian, CMD at New India Assurance, spells out the reason for the underperformance and explains how the company plans to get back on its growth path.
We did a conscious effort in degrowing on bad business from the health sector. That's on the group health side. We did grew out of many group health accounts which were not doing well, and in that way I think we cleaned up quite a bit of health portfolio. Now, beginning this year, I think with this restructuring of the organization, having settled down, people getting used to this new way of working, we are now able to refocus our entire energy on growth with profitability, which was the agenda last year also. But this year possibly we'll be able to see more traction because our regional offices will be focusing more hard on retail business, going more aggressive across all lines of business. We will continue our work on health group health business, wherein we are bleeding on certain accounts, and we will be pricing them better and trying to retain clients at the right price. Okay. So I think with these multi-pronged strategies, we would be able to show growth on a much better footing this year.
The industry is growing its total premium at about 15 to 18%. For you, it's been about 2 to 4% so far. Now that you're saying that the focus will come back on growing premium, what could be the right amount of growth that you could see in terms of the premium that New India could do for this year?
Actually, last year we started this process of degrowing on GMC. We gave up more than 900 crores of GMC business. This year, right from the beginning, I mean from more than 2 months now, we are focusing on increasing the premium for bad business. In the process, we are losing some accounts also because competition is there to pick up such accounts. But wherever we are able to hold on to the accounts, we are pricing them higher and taking on the business. So I can't say that at any point of time the entire bad business is done away with. There will be something because business renews at various points of time through the year. So the process is still on, the effort is still on, and I think it will be on throughout the year. As far as the premium growth is concerned, I agree that we were at 3 point something in the first quarter, and since now we are continuously motivating our retail offices and our agency and other marketing forces to go very strong on retail. We are increasing our product profile and concentration on retail lines. I think in the remaining 8 months of the year, we would be able to show more traction, and we could be showing somewhere, we hope to show a growth figure of around 12% this year.
On both health as total, retail and individual and group, and motor, TP and OD, what could be the growth in these two individual segments for the year?
Health and motor comprise 75% of our book, and therefore the growth will definitely be there. When I say 12%, we expect minimum 12% in these two lines. Otherwise, we won't be able to achieve that 12% on an overall basis. Correct. But then maybe that 12% will be more retail based than it was completely on the corporate base. Like in the health side, we have around 70% of our business coming from group health business. Only 30% is from retail. So maybe we will try to have a better balance over there. Maybe more tilted towards retail than towards group, and the growth coming out of that. Okay. So maybe that would be better management, and the profitability also is expected to go up once this balance tilts in favor of retail, and therefore the concerted effort towards this retail business. In motor, there has been an issue with regards to third-party premium not being increased for the last 2 years, and because of that, the business is becoming unsustainable.
By the end of FY25, by the end of current financial year, where do you see the combined ratio moving from the 160 at the end of Q1, and what is the larger target in terms of the next 2 to 3 years to bring down the combined ratio to?
Actually, quarter by quarter, the combined ratio keeps changing because a lot of businesses renew at various points during the year. Last year, we ended the financial year at 120.57. So this year, the first quarter has ended at 116, which is a little higher than what it was last year. So basically, as we go and with our increased focus on on improving the premium that we write on not so good business, and also increasing our the business that we write on the retail side, which is largely profitable, we aim to bring down the combined ratio significantly. And in the next year, possibly we are aiming at a combined ratio of sub 110%. Maybe 18-19% is what we would feel is possible, and which is ideal in this year.
That is in this year, FY25 itself. Okay. On the underwriting side, this particular quarter, your underwriting loss increased by about 10%. Motor also saw the underwriting loss increasing. Health also saw the underwriting loss increasing in the first quarter. If you could help us understand through the year FY25, how could the underwriting loss, move through the year at the end of FY25 over FY24? What kind of improvement do you see in underwriting loss, as in it reducing? By what extent do you see that happening?
Actually, when we are aiming for a combined ratio of coming down from 120 to 110, surely the underwriting loss would also expect it to come down every quarter.
Very interesting conversation there with New India Assurance, stock higher by over 3% today. But let's now slip into a short break. We'll get you more on the markets and stock specific action on the other side. Stay tuned.